Hello again and welcome. This is Robert Schein, Managing Director, Partner of Blanke, Schein Wealth Management. Thank you for joining us for our market insights and observations. Today is Tuesday, December 6th of 2022. And we've seen the markets in the last 3 or 4 trading sessions sell off simply because we're giving up the gains that we saw based upon last Wednesday's Federal Reserve Chairman's speech, where he was slightly more dovish or encouraging that we could see the Federal Reserve get to a point where they brought interest rates to a level that they're comfortable with, and then they will take a break and see how sort of their impact, the cumulative effect of their impact of their rates actually have on the economy. But the keys that we're looking at are wages in the job markets. That's really what's really keeping this labor tension and the Federal Reserve on this march to higher interest rates to slow the economy. Speaking of slowing the economy, we've seen in the last 24 hours at the banking conference, 2 major banks, Bank of America CEO Brian Moynihan of Bank of America, as well as Jamie Dimon of JP Morgan Chase, both basically indicate 2023 we're going to see a soft landing potentially if the Fed actually sticks the landing, and that's a question that remains to be seen, as well as a potential recession that where you could see multiple quarters, up to 3 quarters of negative growth based upon the GDP. The take-home point by the bank CEOs is they see consumers adding credit and spending, the spending habits. So they get to see sort of the pulse of the consumer. And we know consumer stress because of inflation and stress of everything else that we're seeing around on the kitchen table all the way through, from the gas pump to food and food inflation. So now we know that the CEOs are sort of ringing the bell or warning signals of recession for 2023. Will that message ultimately make it to the Federal Reserve? Well, the Fed's going to be doing what the market's going to be doing, what we're going to be doing, and looking at December's data. And December's data is really, next 2 weeks, going to frame up what the Fed should and will actually ultimately do. And so the market's going to be looking at sort of, the way I frame this is, in order for us to have a Santa Claus rally or the bulls to continue, this is the direction of the economic data that will be laid out in the next couple of weeks, or important meetings that we need to see this play out. So on December 7th, so tomorrow, we're going to see productivity and costs, another economic report. So we want to see productivity go up, that's positive, and costs come down. That would be a positive report. So that's how tomorrow's trading session could set up. As well as December 8th, every Thursday we'll get the jobs unemployment rate. And this is counterintuitive. So in this case, we need unemployment claims to go up. And that's very positive for the markets or the bulls. And then we also need, on the CPI next week, we have the December 13th reading of the CPI, which is November's reading. We should see that down, and that's positive. So we want that. Ultimately, the market's going to be hinged on that, the Federal Reserve, which is consumer price index. Are prices coming down? And they've been ultra hot. That's the problem that we've all been seeing, especially the Fed trying to get ahead of that. That's why they're raising interest rates. Now, we get to, in a few weeks, December 14th and 15th, and we've got the Federal Reserve meeting, which the expectations right now, based upon the Fed funds futures or the way Wall Street's playing it, is based upon 50 basis points that are expected that the Federal Reserve will raise another 50 basis points, taking us about a 4.5% on the Fed's fund rate by the time we're done to close out this year. Now, that would be expected, and that it would be a good thing. That's why I put a positive on the 50 basis points rate hike. What wouldn't be good is anything more than that. If it's a 75, I think all bets are off. I think the Bears will be back in control, or the press conference. Again, every time we've seen the Jerome Powell have a press conference, he basically tries to be more hawkish than normal, as well as just using all of the Fed presidents out there to use this hawkish stance, because they can't afford to have the inflation rate sort of come down but then kick back up. That's sort of the failed interest rate policy. We saw 2 Federal Reserve chairmen, actually 3. Volcker came in the late 70s and then early 80s. So the Federal Reserve was too quick to call victory. Inflation, they paused in the 70s, in the late 70s. There was a pause there, and then all of a sudden inflation came down as the Fed paused. And then as soon as the Fed basically took their hawkish stance and their tone, and they went dovish, inflation just went super high. It spiked. So the Federal Reserve today does not want to basically relive the mistakes of the Fed back in the 70s and early 80s. And so that's what the worry is, and that's where the hard landing, soft landing, and the pause and the pivot, and all this wonderful jargon that we're seeing, it really comes down to earnings, and corporate earnings will be reported for the fourth quarter of 2022 in January. So we're going to have to wait to see how corporations are able to either sort of manage through this and manage their costs, but also maintain sort of the growth in the top line. Also, in the meantime, what else to keep an eye on? Well, if we look at the spreads, the 3-month and the 10-year, or the 2-year and the 10-year of the treasuries, essentially it's inverted. That means when the short end, which is like the 2-year, is higher in terms of a rate than the 10-year. An inverted yield curve has indicated and been a pretty good solid indicator over time through the history of markets to indicate a recession in 2023. So that wouldn't be a shock to anyone, because this has been flashing red on the dashboard for quite some time. Again, the bank CEOs have also discussed that as well. And the U.S. dollar, the stronger the dollar, the weaker the U.S. earnings here. We saw the reversal in October. As soon as the dollar sort of hit the 114 high of this year and started reversing down to the 105 level, we actually have seen a bull market, about 15% off the bottom from that low. So the dollar seems to be strengthening right now. Last couple of trading sessions, that's how I started. That's why the update for today. And as soon as we see the dollar strengthen, we see markets sell off. So there's an inverse relationship that we have to pay attention to the dollar. If it starts strengthening and starts an uptrend, I think the bear market could be definitely giving Santa and the elves a run for their money between now and year end. So there's a lot of economic data. That's why we pay attention to it, because markets are paying attention to it. That's how we're positioning. Keep in mind, we're rebalancing. We own quality. We're dollar cost averaging. We have individual names that we love. We love treasuries. We're allocating to treasuries. So our cash that it's invested in treasuries right now are well over 4% for our clients. So clients love that. We're balanced in that sense, but we're also taking advantage of what's to come. So we're constantly staying on top of the economic data that really move markets. That's our update for today. Tomorrow I'm going to be on Fox Business at the closing bell at 12:45 Pacific time with Liz Clayman. So if you have the opportunity, catch us then and tune in next time. Thanks for watching. We'll see you again next time.